From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And the next thing that we're going to talk about are protective puts. Now, protective puts is a strategy that a lot of people know as stock insurance or portfolio insurance or even ETF insurance. Basically, you're long a position, like you're long a stock or you own an ETF or something, and what you want to do is you want to ensure that you'll be able to sell the stock at a given price, the strike price, to protect yourself. Now, there's a couple of ways to do this. Number one, when you initiate the position, if you want to buy an ETF or a stock and then immediately you buy some portfolio insurance, you might buy a put option. And that will give you the right to sell the stock or the ETF at a given price, the strike price. There's another way to do it. Stock moves a lot higher. You want to lock in a profit. You don't necessarily want to sell out of the stock because you think the stock could still take off. Then you can buy a protective put. Because, worst case scenario, if the stock tanks and, trades all the way down to zero, not only have you locked in your profit, but you've avoided a big loss.
Yeah, and the protective put strategy, and we've already said that we're not big buyers of stock.
Right.
That we understand options.
Right. Some people are.
And, well, not only some people are, but the actual concept of protecting that individual stock actually can be used to, like you said earlier, protect an entire portfolio.
Right.
And we have other classes that talk about dynamic hedging.
Right.
And that's what this is about. Being able to hedge your portfolio as it's balanced against an ETF and buying puts on the ETF and have it an equilibrium there so that way if the market goes down and my portfolio goes down, I am protected by buying a put in the ETF, which is going to mimic the portfolio.
Well,
so it's the same concept as the protected put.
Right, right. And the other thing is that when it comes to hedging in general, which buying a protective put is a way to hedge against a drop, but just in terms of hedging, generally speaking, it's always best to hedge because then you have a clear head. So a lot of the worst decisions are made in the stock market because people are emotional and they make simple mistakes that they look back in hindsight and say, well, that was a stupid mistake. I never would have done that as long as I had a clear head. So when you have portfolio insurance, at least you're not losing sleep at night and you know that you're going to probably make a much better decision with that clear head because you know that worst case scenario, if you're wrong, you're still right, or you're not wrong by much, or you're still profitable.
Yeah, I mean, everybody talks about the psychology of trading. And the one thing is we do know that most of the mistakes that are made were made in haste. People making some type of quick decision because they're panicking. And here, if you are already hedged and you know what your maximum potential loss is and you understand and you're okay with it, then you can make rational, smart decisions instead of being irrational and making bad decisions.
Right.
So hedging is key.
Just to break this down into three main parts. There are three parts to investing or trading. There's number one, understanding the tools to figure out when you think that a stock is going to do something or not do something. That's technical analysis and even fundamental analysis. The second thing is what we're talking about right now, how to best take advantage of those opportunities that you've identified, those high probability outcomes. And once you've identified how to take advantage of it using options and how to see it using things like technical analysis, there's a third component, and that is the biggest and the hardest one to overcome, and that's just human nature. Once you get it at the highest level, you're trading against yourself, and you have to keep that in check. So when you're hedged, you're not nervous, you're able to make calm, cool, collected decisions, and that's when you trade best and invest best.
That's exactly right, and not enough can be said about that because we've obviously had a recent bear market where people have seen their 401ks get chopped in half.
Right.
And the reason was because they didn't have a hedge. And if you understand the protect put strategy and you understand the concept and the mechanism of the strategy, then later we can actually talk about using that concept to not just protect an individual security, but your entire portfolio. And that'll eliminate the chance of the next time we have one of these what's the joke? That your 401k goes to a 201k.
Right, right.
We can avoid that.
And when's it most important to have the clearest head possible? When everybody else is going berserk,
That's exactly right, because that's where opportunity is.
And that's when you're going to want to have money. So if you hedge your position and the stock market crashes while everybody's doing silly things, puking up stocks at basement bargain prices, you're going to have money to go in and take advantage of those big opportunities instead of looking back in a few years saying, remember when I could have bought American Express when it was at $15.
Right. And as they say, chaos breeds opportunity.
Right.
And one of the problems is that even for the people that see the opportunity now,
yeah,
they don't have any money left because they lost most of it on the way down. If they were hedged,
yes,
then they'd have cash available to make these purchases at these bargain basement prices that you're talking about. And, it's a shame that people don't know more about the protect and put strategy.
Right. Absolutely. Well,
so why don't I go teach them about it?
Okay. I think it's a good idea.
Let's go.
Go for it.
Here we have the protective put strategy, and this strategy is very, very important. The reason it's important is this word here, protective. The idea of being able to protect your portfolio is critical. You can make all the money in the world, but if you're going to lose all the money in the world right back when the market moves in the other direction, then it's been a waste of time. We have to figure out how to make money, but then how to keep it. The protective put strategy shows us the concept by which we can protect not only an individual stock, but our entire portfolio as well. Let's take a look at the textbook protective put strategy. First, our construction. Long stock and long put in a 1-to-1 ratio. Our long stock is our impetus. I mean, that's our energy. That's the thing that's going to make us the money. It's the long put thrown into the mix here, which is going to protect the profits that we have. Well, function-wise, it's a little bit different than what we've been talking about. We've been talking about a couple different premium collection strategies. This is a premium outlay strategy. Thing you're going to need to know about a premium outlay strategy is that unlike the premium collection strategies, premium outlay strategies are fully hedged. That means that no matter where the stock goes, I have a specific limited loss scenario. That's what we're trying to do here. We need this limited loss scenario to be protective. If we have the ability to lose a ton of money and the stock goes against us, we're going to lose that ton of money. Here in the protective put, by outlaying premium, we have guaranteed that we are fully hedged. Whatever loss we have will be limited. We'll know the exact dollar amount well ahead of time, and we'll be definitely assured that we'll never lose anything more. Think of the protective put strategy kind of as a life insurance policy for your portfolio. So we've got a premium outlay strategy. That means that what's going to be hurting us? Theta. Remember, theta will hurt us. It's a bullish strategy, definitely. We are long the stock. We're long a put, but the main thrust of this position is the long stock. We are bullish. It's fully hedged, and most importantly, it's normally legged into. Most stock traders own stock, they let the stock run, and then they decide what they're going to do to hedge it. Most of the time, this is what they do. They buy a put to protect the stock position. That's what I mean by legged in. You don't just buy stock and buy put in one big trade. You simply have a stock position. It's been working. You're long the stock for 1,000,000 years, and then one day you see a crash coming, and you don't want to get rid of your stock. I don't know why you don't want it to, but for some reason you don't want to. What do? You buy a put to protect the stock. The nice thing about this position, although I'm not a huge fan of trading the stock at all, the concept is important because we're going to use this concept here to basically protect our entire portfolio by doing something called dynamic hedging. I don't want to scare you too much too early, but the fact is that we have the ability to protect our entire portfolio by buying puts in one of the two major ETFs that kind of track the market, the diamonds or the spiders. Now, for those of you techies out there that are tech heavy, you might be in the NASDAQ heavy stocks. We might go ahead and use the Qs. But either way, what we can do here is use the concept of the protective put strategy to protect our entire portfolio. Now, premium outlay is a little bit of a problem. It's kind of like life insurance. Think about it. You buy a 20-year term policy. You're putting money out every month paying for that. What happens at the end of 20 years? You're alive. That sucks because you've just wasted all that money month after month after month after month, right? Geez, I wish I could have collected on my life insurance policy. The fact of the matter is the only way you collect on your life insurance policy is that you're now dead. We don't want to die, and we don't want our portfolio dying either. You have to look at this strategy as insurance. You're paying every month just to make sure that if something catastrophic happens, your portfolio doesn't get annihilated. Think of it as insurance. We're putting out money every month to make sure that our portfolio stays intact. The problem is that we are now long options, aren't we? Remember what happens when we're long options? We have acquired extrinsic value. And what does that extrinsic value do? It decays. Month after month, this position is going to decay on us. Just the same way as every month you pay your life insurance and you don't die, that money disappears. We have to remember that time decay, theta, is not linear. So we might think about the opposite approach of premium collection. Premium collection, we want to sell that front month where theta is the highest. When we're talking about premium outlay, we might want to buy a little further out so that theta, time decay, doesn't attack our life insurance policy too aggressively. Now, we know that the at-the-money option has the most amount of extrinsic value in any given month. If we're going to buy an at-the-money option, we have to realize that theta, day by day, is going to, it's going to attack us. We are going to lose our extrinsic value of this option day after day due to theta. What are you thinking about now? You're saying, hey, wait a second, if I have to, put forth money to buy a life insurance policy for my portfolio, buying this put, and every day this put's going to decrease in value, I don't want to be doing this for 20 years. What now becomes important? Timing. The one thing that really makes people successful at trading the protective put strategy, or basically hedging any position they have, is that their timing is good. You can't be sitting long and at the money put month after month after month over a long period of time. It's going to eat away at everything you have. We have to be very cautious in this strategy to timing. We have to make sure that whatever we're going to do to hedge ourselves when it's a premium outlay strategy, like the protective put, we have to make sure that our timing is good. Now, is it going to be perfect? No. But good is normally good enough. So we have an at-the-money option that has the most amount of extrinsic value, that has the highest theta, and we know that that theta is highest in the front month. So which month and strike are we probably going to try to stay away from when we're talking about the protective put strategy, a premium outlay strategy? We're going to try to stay away from the front month at-the-money option. That's the option sellers like. That's the option that sellers really kick butt with. We don't want to be in that option as a buyer. We're probably going to look a little further out, not gigantically, but a little further out, and we're probably going to look a little out of the money. Here's the decay chart again, and as you can see, we know that this front month has the most aggressive theta, the biggest theta. It decays a lot more rapidly in this front month. But we do remember that in the out months, we didn't see a lot of decay. Sellers like here. Buyers normally like here. So as a buyer of an option, I'm going to be looking 2, 3, 4 months out, not in the front month. And take a look. We're definitely not going to be anywhere near 15 days, because if we still own that protective put with only 15 days left, we're going to see a rapid decrease in the value of it. We're probably not going to want to be there. We're probably going to roll out if we feel that we need to extend that protection. So just keep this in mind. So many people look at this chart and say, oh, as a seller, I want to sell here. There's another side to it. Remember, if the seller wants to sell here, then in this case, you being a buyer in the protected put strategy, you want to buy out here. The seller doesn't want to sell out there. You want to be a buyer out there. Look at the difference. If we're in a 60-day option, 30 days of protection is going to cost us this slope. The extrinsic value of our long option is going to decay right along this line. If we were in the front month with our protection, look how fast we're going to decay. So we're much better off going out 60, 90 days than just trying to protect ourselves for 30 days. This is the home of the seller. We don't want to be there when we're the buyer. Don't play on his field. Let's play on our field. Let's be the home team. If we're buyers, we're looking a little further out. Are we looking 12 months out, 18 months out? No, probably not. But we are looking 3 months out, 4 months out, not in the front month, unless we're expecting a major crash that's imminent. But to be honest, even if you're just in the 2 or 3 month option, you will have plenty of protection if that crash comes. Let's take a look at profit and loss. Our break even is the first thing we always have to calculate when we're talking about what our profit and loss can be. Our break even is the stock price plus the option price. So whatever we buy the stock at, we simply add the price of the put into the mix. We add it together, and that's what our break even is. Remember, whatever we pay for the option, our stock has to move that amount just to break us even. If we're going to lose on that option, then the stock has to cover for it. The stock has to make up what the option is going to lose. So that means the stock has to go up enough to cover the price of the option. That's why our break even is the stock price plus the option price. Point of maximum profit, as far as possible above the break even. Remember something. We're long stock and long put here. And before I get into the slide on synthetics, but it should be in your head right now, if you hear long stock, long put, what are you thinking? You're thinking long call. Long call. Synthetically, long stock plus long put equals long call. If I am looking at this position in my mind, I'm looking at long call. What do I want if I am long a call? I want the stock to go up as far as it possibly can, as quickly as it can. The point of maximum profit for the protective put strategy, which is really a synthetic long call, is what? Infinity. We want it to go as far above the break even as possible. What's our point of maximum loss? The stock price at the strike of the long put and below. What was that rule of thumb I gave? There were 2 rules of thumb. One of them had to do with an option seller, and the other had to do with an option buyer. We said that an option buyer, when you own an option, the last place you want the stock to finish at expiration is right at the strike of your long option. That is the worst place for that stock to finish. That still holds true here in the protected put strategy. We do not want this stock at the strike price of our long put at expiration, because from there down we are at maximum loss. Now, don't forget that maximum loss is a limited fixed loss. We are fully hedged in this position. If we have $2,000 to potentially lose, we're going to lose at our point of maximum loss all $2,000. But any further below that point in this position, we're fine. We're going to lose $2,000. If it goes down another $10, guess what we lose? $2,000. That's what it means to be fully hedged. No matter how far the stock goes down, our loss is limited to a specific amount. Here is our protective put strategy. Boy, that chart looks familiar, doesn't it? Well, we know that the protective put, long stock, long put, is synthetically equal to a long call, isn't it? What does that chart look like? That chart is the chart of a long call. We've talked about this before when we were saying, hey, you know what? What are you going to do to protect a long stock position? What's the best thing to do? We said, hey, buy a put. This is that. This is that strategy. Long stock, long put. What is that? A long call. We have our break even above this current stock price. Whatever price we buy the stock at, our break even is going to be above that spot by the amount of the value of the put we purchased. Remember, we have to outperform the value of the put before we can make money. We have an unlimited potential reward. That arrow's heading right to the moon right there. But what about this arrow down here on the loss side? We do have a potential loss. Please understand, fully hedged does not mean I can't lose money. Fully hedged means I can lose money, but whatever that value is, it's fixed at a maximum amount. And no matter what happens, I can only lose that maximum amount and no more under any condition. That's what fully hedged means. Here we are fully hedged. We definitely have the ability to lose some money here. But we see that once we hit our maximum loss, no matter how much further down the stock goes, we don't have any more loss because we're fully hedged. Break even right there, obviously above the stock. Unlimited potential gain, limited loss. What is limiting our loss? Obviously our long stock component isn't. Long stock would have an unlimited potential loss on the way down, at least down to zero. It's the put that is bending this little line here and limiting our loss. It's the addition of the put. That's where the protection comes from. That's why it's called a protective put. It's protecting our long stock position. What about returns? Well, we know our return is unlimited above the break even. Once we get beyond that break even, we're off to the races. Remember, the protective put strategy is synthetically equivalent to the long call. So we know that our long call will make money above the long call's break even as far as the stock can go. If this protective put strategy is synthetically a long call, then this protective put strategy can make money above the break even dollar for as far as the stock can go, which is in theory limitless. What about our return on investment? Well, that's actually pretty easy. We have a certain amount of money up. We bought stock and we bought a put. We've got money up. How are we going to calculate what we made, what our percentage return is? Simple. We have to take the entire profit of the position and then divide it by the amount of the initial investment. Remember, we're not just considering the purchase of the stock as the initial investment. You also have to take into consideration the amount of money you spent purchasing the put. The strategy is long stock and long put. In order to calculate what our total percentage return is on this strategy here, we've got to make sure that we have the long stock included and the long put value included. Take the amount we made, divide it by the initial investment, both the long stock investment and the long put investment. Now, in some situations, your return can actually be based on the amount you didn't lose because you were smart enough to hedge yourself. There's a lot of people out there right now that say to themselves, hey, you know what? I feel like I made money because I'm only down 8% in my portfolio, while everybody else is down 40% in their portfolio. In essence, that person really, by saving themselves money, made themselves money. What we have here is a situation where you have to look at what could have happened. I know it sounds kind of stupid to think that you could be happy with a loss, but let me tell you something. If you limit your loss when there's big losses that could have been had, and you've limited yours to a small loss, it is like making money. You are going to feel good about yourself. You're going to feel confident that you made the right trade, even if you're locking in a small loss. Some of my best trades that I've made were trades where I lost. Why? Because I was in a position that could have lost substantially more. And I sat there, I recognized it, I said, you know what, I'm down 10%, but that's not the end of the world. Let me nip this in the bud. Let me protect this here. Let me make sure that that down 10% doesn't become down 40%. I buy my protected put. I've got the put. It locks me down. It protects me. Sure enough, now the stock's down 50%. I'm happy. Why? Because everybody else is down 50%. Me, I'm only down 10%. I feel like I made money. Let's take a look at some returns on the protective put. Let's buy the stock at 60. Let's buy the put, the 60 strike put, for $4. What's our maximum gain? Well, we know our maximum gain is unlimited. As long as the stock goes up beyond our break even, which is going to be what? 64. As long as the stock goes up beyond that, I'm making dollar for dollar as high as the stock can go. What's my potential percentage return? Well, I don't know. Depends on how much money I make first. I know that I have to first get above 64. After that, every dollar I make is dollars of return. I take that dollar of return and I divide it by my initial investment. What's my initial investment here? It's not 60. That's just the stock. My initial investment is 64. I had to pay for this put. That's money out. That's money at risk. That is part of my initial investment. My initial investment here is actually $64. So if the stock goes up to 70, for argument's sake, I've made dollar for dollar from 64 up to 70. Remember, break even and above. I make dollar for dollar from 64 to 70. That's a $6 return. That is not 10%. That is not 10%. That $6 I just made is $6 on 64. That is my return. What's my maximum loss? $4. How? There's $4 of extrinsic value in this put. Remember, if the stock drops, say to 0.56, my stock has lost $4, hasn't it? The nice thing is that this put will now be worth $4. 60 put, stock at 56. The 60 put gives me the right to sell the stock at 60, a stock that's currently trading at 56. I could exercise my right to sell the stock at 60, buy it back for 56. There's $4 of value in that put. Protective put. Delta. Let's talk about delta. What is the delta of my protective put? Well, the easiest thing to do is remember my synthetics. If we can remember my synthetics, everything will be fine. Synthetically, what type of position do I have here? I've got a long call. And if I have a long call, what type of delta does the long call have? Long delta. We have a long delta position. The protected put is a long delta position. We are still bullish. We're just bullish and cautious. We have a long stock position, which is 100 deltas. We've got a long put position, which is going to be short deltas, but obviously less than the stock. When we take our heavy long delta from the stock, subtract the lighter at the money, negative 50 delta, negative 40 delta puts, we're still delta long in this position. We're not saying that we are ready for an imminent crash. We're not saying that we think the stock is going to go down. What we're saying is we're still bullish. We still believe that we're in the right position. However, we're a little more cautious. Why are we cautious? Could be multiple reasons. Maybe I just have a lot of money involved now. Maybe I've had a nice run in the stock. The stock has given me a lot of profits. But remember, those profits are still in the market. And money in the market is money at risk. I don't know why I want to protect myself. But the fact is that I need to at some point in time. So I'm not really sure that I want to get out, but I definitely am a lot more cautious than I was before. It doesn't mean that I'm expecting or planning on the stock going down. I want to make sure everybody understands that, because people think that you buy that protective put, you think the stock is going down. No. If I thought the stock was going down, sell the doggone stock out. I am just concerned that the stock could go down. I am definitely still bullish. This is still a bullish position. My gamma's long. How do I have long gamma? I've got long options. Whenever we buy an option, the protected put has a long put. Whenever we buy an option, we're going to become long gamma. And when we buy an option, we become short theta. Time decay is going to start eroding the value of that put. That's why I said timing is so important in this position. We need to make sure, beyond a shadow of a doubt, that our timing is as accurate as possible. Did I say that your timing is impeccable? No. Did I say that your timing is dead on the money? No. I said your timing is as accurate as possible. We don't want to be buying too much time. More time, more decay. We don't want to have a life insurance policy for longer than we need it. What's our Vega? Obviously, our Vega is going to be long. We have purchased an option in this position. We're long options in the protected put strategy. And if we're long options, we're going to be long Vega, because we acquire long Vega via the purchase of options. Here's our chart again. Let's make sure that we still understand what we have here. If you look at that chart, we are definitely still bullish. So many people think the protective put, we do this when we think the stock is going to go down. No, we do it in case the stock goes down. We are still bullish. We're still expecting upside, but now for some reason we're a little concerned and we need to cover our rear end. So what do? We don't sell the stock out. We buy the put for protection. If we really felt that there was a crash that was imminent and we're going to see much lower prices in the market, we would have just sold the stock. We're not doing that here. We're not selling the stock out. We're simply protecting it. We're bullish but cautious. As I said before, the synthetics of this position is we're long the corresponding call. You just saw that chart. That's a chart of a call. Long stock, long put equals long call. Synthetically, this protective put strategy is going to act the same exact way as that long put's corresponding call. That means we can look at that call and get a value of our entire protective put position. All we have to do is take the call, subtract interest, and add dividend, and we will have the value of the protective put strategy. This is a component, like everything else, of the reverse conversion. It's two legs of the conversion. We're long stock and we're long put. What are we missing? Short call. We're long stock and long put. That equals long call. If I sell the real call against this, I've done the conversion. I've locked the position down. Whenever we're in a protective put strategy, we know to get out, we don't have to make two trades. We don't have to sell out the stock and sell the put. We can simply sell the real call, the real corresponding call. Puts us into a conversion, and now we're locked down and done. We're in that position without a position, the arbitrage. How does this protective put work? Well, we do understand that we're in a premium outlay strategy. And we do understand that we're acquiring extrinsic value. And that extrinsic value is going to decay over time. Time goes by, our put will lose value, just like a life insurance policy. Now, what we need is to actually be wrong in the put. Let me say that again. What we need is to be wrong in the put. The put is protection. What we need is for the stock to run. If the stock runs, you might say, oh, I protected myself for absolutely no reason. What am I doing? No. You had a moment where you said, I am concerned about the value of my stock or my portfolio. Something in the market scared you. So what did you do? You went out and you bought protection, which is fine. But the fact of the matter is that you want to lose money on the put. You want the stock to run up big and have that put go to zero. It's kind of like the whole idea of a life insurance policy. I don't want to collect on my life insurance policy because if I do, I'm dead. If you wind up having your put make you money, that means the stock has collapsed. And if the stock collapsed, you have an overall loss in the position. You'd rather see the stock run up and have that put go to zero. I want to lose money on my life insurance policy. I want at the end of 20 years, they say, well, Ron, you just wasted $800 a year for 20 years. And I'm going to say, thank you. Here's some roses. Here's a bottle of wine. Thank you very much. Can I get another one of those 20 years and lose on that again? You have to remember that you want to lose on your protection. The protection is there in case. Now, that extrinsic value loss, you have to view it in a positive way. Too many people get into this whole mental psyche and zen of trading horse manure. I just can't see it. The fact of the matter is, if you understand the markets, you know you're going to win and you know you're going to lose. This is a situation where I want to lose. I'm not going to get damaged emotionally and psychologically because I lost money on my protective put. I'm going to be happy. The amount of money I lose is basically just the cost of the insurance policy. I'm damn glad that I lost money on my life insurance. I want to be just as glad to lose money on my portfolio insurance because that means my portfolio is intact. My nest egg is still together. So all we're doing right here, by paying out, by buying the put, we're giving up a small amount of our profits to lock in a larger amount. We're sacrificing a few good men for the greater good of the big bunch. We need to make sure that we understand that losing here is a good thing. It's not something to get upset about. Now, we have definitely a maximum hedge situation here, don't we? Premium outlay hedges are full hedges. They are maximum hedges. We want to make sure that we're hedged so that way we have a shot at higher prices in the future. We can't be making money while we're losing money. We want to make sure that we guarantee that we're going to profit for higher prices. How do we do that? By staying in the market. How do we stay in the market, especially in bad times? Hedging ourselves. So why am I going to use these protective puts? Number one, I'm going to lock in profits. I have a certain amount of money I've made in the market. I would like to keep that money because giving it back doesn't do me any good. I want to make it and keep it. The protective put strategy shows us a way of making sure that we guarantee that the profits we have, for the most part, stay there. I don't mind giving up a little, but I mind giving up a lot. The protective put makes sure that I never give up a lot. I want to take away the risk in my position. I want to be able to sleep at night. I don't sleep at night now. Think about how much I really wouldn't sleep at night if I had to worry every day about my portfolio, all night long, day after day. The protective put strategy, the ability to hedge my position, allows me to sleep at night. It allows me to be more patient. I don't have to rush and worry about my portfolio. I don't have to make drastic, stupid maneuvers because I'm nervous and scared. The protective put strategy eliminates your fear of loss. It says, hey, look, you could have lost this amount, but if you put up that amount, you won't lose the bigger amount. That's what we're doing here. Now, me personally, and one day you too, will know that it's a waste of time trading stocks. I would have loved to have said that when we started this, but I couldn't because it would make you think that I was a maniac. But as you start to learn more about options, you're going to see that there's really never a reason to buy stock. It's a waste of money. It's a sucker's bet. Options the right way are definitely the way to go. So what do we do here? We can actually hedge our entire portfolio. The entire portfolio, not an individual stock, the entire portfolio by dynamic hedging. If I can have my portfolio balanced with an index or an ETF, even better, then I could hedge the ETF instead of hedging my portfolio. I can use the ETF to hedge the entire portfolio. So when are we going to use the protective put? Basically when we're anticipating a short-term potential downtrend, something that can take the life out of our stock, something that's going to hurt our stock. What we can do is in the short term, we can protect it with a protective put. We probably don't want to be using a protective put over the long term. Reason being is because it is a premium outlay strategy. The more that we have to use it, the more money we're going to lose in using it. So we have to try to protect our position when we really need to. That's why I said timing is so important. We don't want to buy too much time, ever. And if we can stay away from using the protective put until we really need it, we'll be better off for it. But when in doubt, you're better off having it on than not having it on. This is really good to use when we're trying to protect profits. Remember, making money is wonderful, believe me. But the fact is you got to be able to keep it after you make it. If you make it and give it back up, then there's no sense in making it in the beginning. So we might as well protect what we have and make sure that once we've made it, we keep it. When we want to have a situation where we were going to protect profits, but we wanted to still make money. I mean, I know that sounds kind of weird. We want to make sure we don't lose what we have, but we still have to be in position to make more. The protective put strategy is perfect for that. Remember, we're going to have a put that protects a long stock position. It's going to make sure that we keep the majority of our profits. But, as you recall, this position still makes money to the upside. Once we get past our break even, we can make dollar for dollar on the way up. What we need to understand is that protecting our position doesn't mean that we have to get out of the position. We can still be in the position with protection and still benefit from a further movement upward, obviously, in the stock and benefit from additional capital appreciation in this position. It's also a good position to use when we have a positive put-call skew. Remember what a positive put-call skew is. When the calls are trading higher volatility-wise than their corresponding put. If we see that situation, instead of buying the call at the higher volatility, we could buy the corresponding put at the lower volatility. Enter into that trade at a better effective price. We buy the put and buy the stock. That means we're going to be buying the call synthetically, but at the lower volatility of the put instead of buying the call outright at the higher volatility. Now we want to take a look at how do we identify times from a technical standpoint to employ the protective put strategy.